It is so good to have you all here. How many here was in the other room? A few. Good. So you know, all of you, that you are at this summit today, and we want some action. Right? So what is going to happen after today? That is what you're going to put in your notebooks or whatever you use to ensure that it's not just a fantastic day where there's a little bit of aircon. Think about what you're spending in here of aircon, but actually you have some action out of it. So my name is Helle Bank-Jorgensen. I'm the Global Managing Director, Board Intelligence. So I work with board of directors all day and have this opportunity to also talk to board of directors about climate and nature, as I also serve at the World Economic Forum Future Council for Climate and Nature Governance. But today I'm your MC in this room. So I'm just here to ensure that we have the most fantastic panels, keep them on time, perhaps have a question or two, and really ensure that all of you getting something out of today. Keep your questions. We might have questions in between. When we have questions, I ask you to just who you are and then your question. Okay? And I think with that, we have the first half hour. Yes? Yes. Amazing. Claire, you're on to talk about your fantastic panel. And
yes, I'll invite my panelists to come up, please do. In the interest of keeping to time. Good morning, everybody. Welcome to the London Stock Exchange. I'm Claire Dorrian. I head sustainable finance here, and have the privilege of chairing this panel, which is really dear to my heart because, at the Exchange we are very focused on how we can make sure that we're providing access to capital and convening the markets. My team spend a lot of time on green finance and carbon markets and the transition and how do we solve for those problems. So yes, I think we have a good exam question, I think, here to answer for my panel today. On carbon markets, I think half an hour, we'll try and do as much justice as we can, but I think where we were really sort of coming to some conclusions when we've been talking is that the carbon markets have got a really key role as a mechanism for financing emissions reductions. And alongside that, also the environmental projects as well. And so with my esteemed panellists here today, our exam question is how are we going to address how can you actually sort of look at both the compliance and the voluntary carbon markets, and how can they support climate resilience, how can they influence capital allocation, and help manage systemic transition risks across sectors and geographies. Big question, half an hour. So I think actually what we really want to do is to crack on, first of all, with the questions. I'm going to invite Gina Hanrahan, the Head of Economic Policy at the PRI, to address my first question, if you may. And I think we know that they were originally designed, the carbon markets, to finance the emissions reductions, but they can evolve into different tools that help investors, they help economies, how they manage that transition risk. Or are they sort of expectations now, really exceeding that original purpose that they've been set up for?
Thanks, Claire, and hello, everyone. Lovely to join you here today. I think expectations have always been incredibly high for what carbon markets can deliver from their very inception. I was reading a really nice piece in the FT the other day. It was quite tongue-in-cheek, but it was talking about the kind of econo-splaining that's been going on about carbon markets for years, the perfect way to address externalities and realise the right price. One day we'd have a global carbon market to rule them all. So I think, that's always been a very, very high bar, but often for a fairly narrow purpose, which was least cost abatement. Yeah. But I think in practice, as you say, they've always been much more than that. They've been tools for reducing transition and systemic risk, giving predictable price signals to investors and investee companies. They improve the visibility of the real economy transition, make clear what's going to happen and what's going to bite. And for investors that are diversified across the economy, I think they do provide a very clear framework for capital allocation across sectors. I think one of the really important elements in this is the importance of policy stability. And I was in the session a little while ago where the gentleman from Baringa was talking about the importance of or his hesitancy to build in policy into the investment case and needing to hedge against that. And I think that importance about the signal that carbon markets send, that governments are taking this seriously and that they're committed to a long-term transition is really, really critical. That's playing out in the EU at the moment with the EU emissions trading scheme. There's a very, very live debate about the potential to weaken the system. Some industries and a number of governments are pushing back, facing very high energy prices and talking about diluting some of the architecture. The PRI and IIGCC recently convened a letter which was signed by 50 investors with over 13 trillion euro under management and endorsed by the asset owners in the Net Zero Asset Owners Alliance. And that really emphasised the role of the ETS in transition risk management, not in least cost abatement. So there are a lot of principles in that letter: clear long-term price signal and trajectory, governance mechanisms that limit stability, phasing out free allowances, and crucially the use of revenues deployed to the right places to support industrial competitiveness, but also to manage distributional impacts. So I think that's very much a transition risk management argument. There's one other perspective to bring in. I think they are not a panacea, and I think the most sophisticated understandings of how carbon markets work is part of a coordinated system for transition change, transition management, alongside sectoral policy, alongside R&D and innovation and all the other things that we know are needed. And I think the most credible compliance systems that are emerging, and they do interact, we can talk about that a little bit, with voluntary markets, they understand this. So Japan, for instance, is building out its approach to its GX ETS, but it's situating that in the wider GX program. Equally, Brazil has legislated for its carbon market, but it's building that into a really credible transition roadmap, its ecological transformation plan, its de-risking mechanisms, its investment platform, taxonomies. So that's there as part of an important policy mix.
I think a really, really important point you land there about this coordinated system.
Yeah.
You do need the market, in a sense, sort of to be collaborative to get to that success. And I think the challenge is you've got a lot of different participants in the market that perhaps are not always sort of aligned in the end goal. But Jack, did you want to build on a little bit more of what Gina was saying, and sort of give that the World Economic Forum view?
Yeah, maybe just one element. I appreciate Gina's overview of the situation. I think one of the things that I want to go back to is this notion of transition, right? So the carbon markets were set up to expedite and facilitate a transition to a different way of investing. If we look at things from the nature and the nature side of things, with nature-based solutions, the thing that needs to be transitioned is how we manage natural resources for climate outcomes, for biodiversity outcomes, for social and economic outcomes. And so the question remains, have the markets actually affected a transition in how we manage this? Has it made an incremental difference in the amount of resources going into land and water management? Has it fundamentally changed government policy, corporate practice, civil society engagement in how we manage land and other resources? And I think the jury is still out on that. I think in many cases, when you look, and this has gone back over the last 30 years, when you look at the experiences in the field, specifically in tropical forest areas, but not exclusive to tropical forest areas, you do see this supplementing going on where carbon financing comes in, and in certain instances it's supplementing or complementing what governments are investing in land conservation, or which forestry companies are investing in natural forest management, et cetera. But in many cases, it's substituting for investments. And it's basically serving as a conservation finance tool rather than specifically what it's designed as a something to help facilitate a transition. Mm-hmm. And I think that's something we have to be very aware of, because there's long been this conflict in the conservation and environment community between are carbon markets designed really to address CO2 emission reductions, let's say predominantly in the global north, or are they designed to present a conservation financing mechanism for things that are generally required in the global south? And depending on where you sit in that conversation, you give a greater adherence to the notions of the importance of additionality, permanence, and leakage in that conversation. If you're looking specifically as an emission reduction tool designed to facilitate a transition, you're going to skew really tightly to the importance of additionality, permanence, and leakage. If you lean a little bit more towards this is about conservation finance, socioeconomic development, livelihood creation, and such, you're thinking, okay, this is really a financing tool, an economic development tool that's really important. And that issue has been at the core of the debate for the last 30 years. I think we still have some ways to go with it.
Yeah, I agree. I think that is an area, if we're going to take away some homework that needs to be focused on, is that conflict, because that's manifesting itself in lots of different areas and actually can end up being sort of that barrier for progress and the barrier for getting financing into those projects. I often say sort of the carbon markets world and the ECM world, the equity capital markets world, do not talk the same language. And so we've got to think about how can we, where are there participants and players in the markets that can sort of insert themselves into the middle of that to help to facilitate really proactive and progressive conversations. So I think, look, your point as well, you said about the jury's still out. I think that sort of leads us nicely into a question. Well, then how actually should the compliance carbon markets and the voluntary carbon markets interact to create a little bit more of a sort of a coherent and credible pricing mechanism? I'm looking at you there, Gina, if you want to take that one, because I think you alluded to that in your first answer.
Sure. I mean, I think we've often thought about carbon credit markets and compliance markets as two separate lanes, and actually there's a much greater blurring of boundaries in latter years. The latest data shows that compliance markets are increasingly driving demand for carbon credits, and voluntary buyer demand is plateauing. So I think it's increasingly influencing what's happening in the carbon credit space. So we have domestic compliance markets in a number of different jurisdictions that are integrating flexibilities around credits. So you have Korea, California, the Brazil legislation, I think, and others. And international compliance mechanisms also around aviation, so the Corsia scheme. That's also driving demand there. So there's a real blurring of those boundaries. And I think probably the biggest long-term demand signal sits in the EU. Mm-hmm. It's 2040 climate target and the legislation that underpins that legislates for up to 5% of emissions reductions from 2036 to come from international flexibility mechanisms. So at any plausible credit price, that's actually potentially a really significant financial flow into nature-rich economies in the global south. I think that's a really interesting dynamic. Yeah. And it's also potentially driving conversations around integrity.
Yeah. Ambassador Ali Mohamed, I'd love to bring you a little bit more into the conversation and to bring sort of the international, the Kenyan perspective here as well, as to this coexisting of the compliance and the voluntary markets. What's your sort of perspective? And I know you were already here earlier in the week as well when we supported the update on the coalition to grow the carbon markets and how important it is for you to work across different jurisdictions collaboratively on this agenda.
Well, thank you very much, Claire. And I wanted to add to what the colleague on the panel was saying. I come from the global south, and therefore this contention between whether it is about contributing to transition or contributing to economic development, I think we lean more onto the fact that for us in the global south, what we see carbon markets doing is contributing to the whole development of the country, and the communities who are contributing and working on carbon markets really are looking at how they can monetize and benefit from the work they're doing on a daily basis as part of their livelihood, conserving environment and so forth. So really the issues of leakage, additionality and all that, I mean, those are very good terminologies for people who are looking at the transition. But if you have nothing to transition from, in the first place. So I like that, and I think that diversity, or what do you call it, the differences needs to be bridged more, and I hope in places like here is what we need to see how we can bring that reality together. Talking about the issue of compliance and voluntary. Of course, the most critical thing for governments as well as for the buyers is to make sure that first and foremost there's the integrity of the product that you're presenting to the market is high. As governments, what we're doing is to make sure that the carbon credits are high quality, and so that we can attract the right buyers and so forth. In addition to that, of course, they must be aligned to the priorities of the countries. We all have submitted NDCs, and we have targets to meet as countries, and so it's working towards ensuring that our credits that we market meet the objectives of the country, they meet the safeguards that we have put in place, and of course provide the certainty. We all need to sell the credits about demand and supply, and therefore we must have the certainty. I think I agree with you. It is blurring the difference between compliance and of course we've already signed agreements with bilateral agreements. The COSIA is coming in and all that. But the difference is really not that important for the people who are generating the carbon markets. And the most critical thing for us is to make sure that we try to provide the certainty for those who are going to partake in the process of the trade of the carbon markets, that there's clarity on how it's approved, there's clarity on how we issue the authorizations and all that. And ultimately, of course, we are now at 2026, almost mid-year, and we have targets up to 2030, how we meet that 2030 targets. Our first NDC, we submitted at 3.01, but the first one that we need to comply and present a result for is the 2031. So how are we going to make sure that we meet the objectives of the 2030? Then financial flows. I mean, I really get... well, it's very encouraging to hear trillions and billions being mentioned in places like here.
Yes.
But the reality is those billions and trillions, with all due respect, just still seem to be in the air there, somewhere out there.
Yeah.
So how do we land these trillions and billions that are available from whichever carbon market entities providing that, whatever grouping of carbon markets is? How do we land that to make sure that ultimately it arrives or it goes to the people who are most needy, and the investments that are required? Because we are struggling as countries like Kenya to really finish and take forward our project. They're all startups, and we can't even get the small amounts that are required to mature it to the next stage. So I think there's a lot that needs to be done, and therefore we launched the coalition to grow carbon markets together with Singapore and UK, and we're working with business entities, the WBSD and others, and we hope that through that coalition we'll be able to respond to the challenges that the business sector faces as we improve on our side also as the providers of the carbon credits. But importantly, I think NBS is a very important component of it. We've been pushed more and more to tech-based credits. Yet we know the reality of the world is without the nature-based solutions, I'm not sure whether just tech alone is going to solve the problems of climate and so on. Yeah.
No, I think lots of nodding from the rest of the panel. I think you agree. I think there's really valid points as well around sort of where are these millions and the trillions, and not alone. I think in sort of wondering how that filters through. And we've been hearing a lot. I'm sure everyone has during London Climate Action Week. It is about the implementation of promises and agreements that have been made. And I think we're probably going into COP31, we need to keep that focus as well. Jack, did you want to
just want to see if I could maybe make a comment on something the ambassadors just said here. I think when you look at the abatement curves and you sort of think about the low cost investments that can be made, the nature-based solutions always score very high on the lowest cost, right? And so I'm trying to reinforce what the ambassador said, is that we often see money going into technological solutions, and often that is because that's facilitating the transition to something different. That's a technological, it's making a change in the technology, or it's making a change in a business model, and people can see where that's going to grow the market for a certain commodity or a certain technology or a certain product. And that's totally understandable, because that's how markets work. And yet at the same time, if we go back to the original intention here, which is like, how do you take carbon credits and steer them to the lowest cost mitigation strategy, you're always going to end up in the nature-based solutions. And you have all the additional benefits, socioeconomic benefits that go with that. And those are the types of transitions that are probably more important in the global south, where you do have societies that are more heavily focused on agriculture, forestry, fisheries, and things like that. And so again, it's this perspective that there is this, there is this north-south dynamic, there's this rural-urban dynamic. And I think there's a lot of energy on the part of the global south in saying, how do we drive money into the types of transitions that are important to us in the global south, not just the ones that are important to where capital allocation decisions are made in the north.
Absolutely, yeah. And I think we were saying before, weren't we, as well, that it is about the money getting into the projects a lot more than perhaps the trading activity of those carbon credits, because ultimately you want to be procuring carbon credits to offset residual emissions alongside decarbonisation strategies. So, let's focus a lot of the intention of getting the money into the right projects that are going to generate those credits. I feel like that perhaps leads us quite nicely into a question that we wanted to cover around investor confidence and what matters for that, because ultimately, in order to get the scale, you need to have market confidence in the projects, or is it stronger market integrity? Is it higher carbon prices, or is it greater policy scrutiny? Gina, what do you think? Sort of, if you had to pick one, or maybe comment on.
I don't think I could pick a favourite, because look, they all interact, don't they? I think. Carbon prices are the outcome of policy stability and market integrity, and there has been great efforts made to address a lot of the kind of wider integrity issues in credit markets in latter times. With there's a raft of new standards and principles that have really driven increased confidence in those markets, and we're also starting to see policymakers increasingly regulate some of the issues around integrity and even how we can claim, how we can claim those credits are used around carbon neutral strategies, etc. I think there's a real risk of treating price as the primary metric, and that does happen often in our political debates. Because that invites political interference. If the price goes too high, there's an immediate pushback that it's not sustainable, and there's that industry is facing unsustainable costs. Equally, there can be pressure on the other side on ambition. So that long-term stability is absolutely core to investor confidence. And I just wanted to pick up on one of the things that the ambassador was touching on around the benefit sharing, and I think the increased focus on equitable benefit sharing is absolutely necessary, and we're seeing some of the most advanced practices and policy contexts for that emerge in African economies who are regulating particular aspects around that. So that's really welcome to see, and I think an important confidence enabler for investors and companies. Yeah.
Jack, you talked before about the sort of the north-south divide, the rural, the urban divide. I'd like to sort of pose a question to you and to the ambassador as well, please, about how do we then ensure that the value that's been generated by the carbon market is actually genuinely shared then fairly between the project developers, between the host countries and investors. Jack, do you want to jump in first, and then
sure.
The ambassador?
I was hoping the ambassador would go first, but I'll give it a go. So, look, I think this notion of integrity is super important, right? And the best project developers out there are focused on integrity, and they've got very clear statements around where the resource flows go. Now, obviously, it costs a lot of money to develop a project, and there's a certain amount of fixed costs, irrespective of the size of the project and the number of carbon credits that get generated. But there does need to be an upfront commitment on the part of project developers about which portion of this resource is going to stay ultimately in the community and what types of things are going to get done with that resource within the communities. You know, whether it's straight up conservation of forests, whether it's conservation of forests which is linked to education, and whether it's linked to public health issues, whether it's linked to other livelihood creation opportunities. I mean, I think often you would see this conservation finance work going to improve a whole bunch of other socioeconomic outcomes, and that's clearly what I shouldn't say clearly. That's often what communities are really striving for here, and obviously that's in the interest of governments as well. I think that where things break down a little bit is when you've got a overly mercantile focus on the part of the project developers, where they're trying to develop projects, they're trying to figure out how can they minimize the amount of money that's going to the community, optimize the amount of money that's staying to the project developers, and then getting those credits at a reasonably low price to the ultimate purchaser. And that's where things get tricky. And so I think the standards the standards that exist, the integrity of the project developers themselves, and the actual leadership, I think, of governments in saying what kind of carbon market or carbon credits do they want to see floating around their countries. There is agency there on the part of governments, and I think this is where solid policies, plans, and public programs around the utilization of carbon credits can come into play. And maybe the last thing I'll say on this is that when we do think about this notion of transition, one of the things that's also transitioning is how governments make decisions on the utilization of their own natural resources. So solid land use planning is a good investment on the part of the governments if that can also facilitate investments from the carbon market. Solid notions of governance and integrity on the part of the government can facilitate, and it can be a race to the top, if you will, in terms of which countries and which types of jurisdictions are really attractive to the markets. And I think that is the type of transition that I think everybody has an interest in bringing about, including the national governments and subnational governments as well. So please, Ambassador.
If I may add, Claire, let's be honest, carbon markets are well managed, are making real transformative impacts on communities. I am privileged to sit in a particular project that has, I think, the largest so far in the world on soil carbon, and I've had the opportunity to go and visit villages in my country where this project is, and I have seen firsthand how they have benefited and is transforming their lives of those communities. So well managed, it has had its fair share of controversies and bad press and headlines and all that. But well-managed carbon markets have the opportunity to make a real difference. And so I think what we are doing as governments now, after the conclusion in Baku of the Article 16, we're putting in place the necessary institutional mechanisms. First and foremost, to provide confidence to the investors, but most importantly also to manage the credits and so forth, and to see how the resources are shared. Of course, we all know that there are too many intermediaries in the whole carbon markets space, and most of the funding, unfortunately, before these regulations have come to place, have been benefiting these intermediaries who are faceless in most times. But now in Kenya and many other places, we have put in place benefit sharing mechanism. So there's a specific percentage that is given. For example, in Kenya, I think it's about 40% for NBSs and so forth. I think Tanzania is about 60% and so forth. So now I think we are all trying to correct what was happening before. But coming from Global South and Africa for that, I think there is huge opportunity if we get it right, that it will both address what we set up to address, which is the emissions that continues to grow every day, but also take benefits to the people also who are making the contributions. So I think carbon markets are good, certainly, and we have a lot of expectations, all of us, how it's going to help, but we continue to manage and see how to land it fairly for all of us.
Thank you. Look, fantastic perspectives. I think sadly, we're going to have to end the panel. I say sadly because I was really enjoying that conversation, and I'm sure, and I hopefully we've also I think we have answered some of the exam question, and those, you know, some of the next steps that we really need to help to move forward and use our influence, you know, within our respective organisations and our countries to actually, you know, make the progress that we're all striving for. So let me ask everybody to just say thank you and a round of applause to all of the panellists for a fantastic job. Thank you so much. Thank you.